Take me through it, Steve.
Righto, Mark. Well, we had the GDP numbers come out, and then we had a really disappointing GDP result. It was only 0.2 quarter on quarter. It was actually negative in per capita terms. I'm moving that one straight to neutral. On GDP, if we get another weak quarter, that's when you get that risk of recession. Maybe in 3 months' time, that will move to the easing side. Inflation, persistently high. And remember that is probably the dominant issue for the Reserve Bank, as we've been discussing. Inflation is still high. It's coming down. Yep, it's coming in the right direction, which is good news, but not fast enough for the RBA. So if inflation was the only thing that was that high. And just by the way, on inflation, one of the things that I love to look at are global commodity prices. And that's the price of oil, gas, wheat, wool, gold, copper, iron ore, the full basket of commodities. Agriculture, metals, energy. And that's proven to have a good correlation with future inflation. Doesn't happen immediately, so the price of oil or iron ore might drop 10% last month. Doesn't flow onto prices for finished products yet. It takes a few months for it to happen. That's at its lowest level.
The whole basket?
The whole basket, lowest level in about 3 years, and coming down quite nicely. Nicely in terms of your inflation outlook. So based on that, you'd say inflation's going to fall further. However, the RBA's still got to be in its bonnet about actual inflation. Linked to that on the labour market, well, we had a surprisingly strong jobs report last month. I'd put that in neutral to tightening because it's still a solid number. Unemployment at 3.6%, so it's still low on a historical basis, even though all the leading indicators, job vacancies, job ads, are all turning down. So you'd say that future unemployment will go up, but we're not there yet. Wages, well, the RBA put a high weighting. We spent a moment or two discussing that. The Fair Work Commission pay decision about a month ago, the 5.75% increase was bigger than the RBA were assuming, bigger than everybody was assuming. It was a chunky pay rise.
And 30% of the working population get it.
And they'll get that or some derivative of it. So wages got a bit of a kick. And in fact, the RBA governor, when they hiked rates, when they shocked us all earlier in June and hiked rates, they put a paragraph on wages, which is more than they normally do.
I just thought that was trying to make a point, but anyway.
Yeah, I think it's trying to make a point, but they made the point.
Yeah, they made the point.
So wages there. Now, international economy, weak. Germany's in recession. US is slowing down. UK's in huge trouble. It's in recession. New Zealand's in recession. The world economy is weakening. On the world economy alone, we mentioned China, it's slowing down. You'd be cutting rates if that was the only thing that was...
Yeah, but by the way, he always says, we're going to keep an eye on the world economy, yeah. Global growth.
Yep.
Well, global growth, man, is
looking crook.
Looks bad.
Yeah, it is. And if you look at, the countries that make up about 75% of world GDP are the Eurozone as a whole, the US, China, and Japan. They make up about 60 to 70% of world GDP. They're all either in negative GDP or just about to be in negative GDP. And don't forget, they've all hiked interest rates too, and the full effect of their rate hikes hasn't impacted their economy. We could be sitting in the US, while the conversation would be slightly different, the lagged effects of earlier rate hikes would be exactly the same. So there's a pipeline of tight policy yet to impact those economies.
Especially in the US where they're mostly fixed rate, and the interest rates haven't really affected most of the borrowers yet.
Correct. It's hitting the corporate sector,
yep.
But not so much the household sector. But as new loans are trying to be written, that's where you get the kicker.
They get put in at a new fixed rate, a high one.
Yeah. Retail sales, dismal, falling in real terms. We've stopped spending. We consumers are being impacted by high rates, cost of living pressures. Consumer sentiment, as I mentioned, Westpac measure is in the doldrums. Consumer sentiment's miserable. Building approvals, lowest level in a decade. And in fact, if you want to think about house prices, again, while interest rates do have an impact, if we've got building approvals running at the lowest level in a decade, when population growth is growing at its fastest level...
Of course house price is going to go up.
Supply and demand. Economics 101.
Yeah.
Not even economics. You did it in year 10 economics.
Yeah, 100%. I don't understand why.
Huge demand, no supply. What happens to prices? Go up. You don't have to be John Maynard Keynes to work that one out. Business investment's okay. I put that in neutral. One thing, thankfully, that's probably going to work against the risk of a recession is that businesses are still investing on machinery, on IT, and some buildings, not CBD office blocks, but warehousing and sort of these sort of things. So business investment's doing okay. And so is business confidence. While we consumers are gloomy, businesses are doing okay. Commodity prices, I mentioned before, falling. I'll put that between neutral and easing, but that's a sign that global economy is weakening. Demand for iron ore, oil, wheat, these sort of things is starting to come off. So that's an early sign. Stock market, I'll put that in that neutral to easing column, even though a bit like house prices. I've never heard the RBA hiking or cutting because of the stock market going up or down. I don't even think they did in 1987 when we had that crash. I think they held off. But yeah, anyway, it's still an important part of wealth. And the current level of interest rates, 4.1, I'd put that right over in the easing column. They've done enough. In my view, they've done enough.